Welcome back to the Deep Dive. It is Saturday, February 7th, 2026. And I'm going to start today by asking you to do something a little unpleasant. I want you to look at a calendar.
Oh, well.
Because if you are anything like me, you're just cruising through February thinking, you've got all the time in the world. But we have a legitimate ticking clock situation on our hands.
We certainly do. That window is closing really fast.
March 2nd, 2026. That is the hard cutoff. That's the deadline for your 2025 RRSP contributions, the famous first 60 days rule.
Right.
Now, usually when we talk about this, it's kind of the standard eat your vegetables financial advice. You know the drill. Save for retirement. Do it for your future self. But looking at the research you brought in today, we are not talking about standard advice.
No, not at all. Today isn't about saving for a retirement that's, 30 years away. It's about using that deadline to solve a very immediate problem that is happening right now in 2026. This isn't just about accumulation. For a lot of people, it's about survival.
You've called this deep dive fiscal arbitrage, which I got to say sounds incredibly sophisticated, maybe even a little intimidating.
It does, but when you strip away the jargon, we're basically talking about how to use the Canada Revenue Agency's own money to attack your mortgage.
Okay, that I can understand.
Yeah, it's a strategy we call the double win. And given the specific economic landscape we're in right now, this has kind of moved from a cute trick for finance nerds to a necessary defense strategy for homeowners.
All right, let's dig into that context first.
Yeah.
Because you keep saying 2026 specifically. Why this year? What makes this strategy so critical right now compared to, say, 2021?
It all comes down to something the banks are calling the renewal cliff.
I've seen those headlines. It sounds ominous.
It is a massive stress test for the Canadian economy. You have to think back to the pandemic. Back in 2021, we saw interest rates at, historic lows. People were signing 5-year fixed mortgages at 1.5%, maybe 1.7%.
I remember it felt like free money. You felt foolish not borrowing at those rates.
It basically was. But now the bill is coming due. Those 5-year terms are up. And the data shows that something like 60% of all mortgages in Canada are renewing across this 2025-2026 window.
And the rate environment today is a little different.
Drastically. As of right now, February 2026, the Bank of Canada's policy rate is at 2.25%. But the prime rate at the big banks, which is what really matters for your mortgage, is sitting at 4.45%.
So you're looking at people who budgeted their lives around a 1.5% rate, suddenly facing 4.5%, maybe higher.
Exactly. And that's the payment shock. For a lot of families, that could mean an extra $800, maybe $1,500 a month just gone, vanishing into interest payments.
Wow.
So the whole thesis today is that you can use the mechanics of our tax system to soften that blow, to aggressively pay down your mortgage principal before the bank can charge you that higher interest on it.
Okay, I'm listening. That sounds great in theory,
Oh.
but I have to play devil's advocate right out of the gate.
Please.
It's February 7th. The deadline is March 2nd. The biggest problem for most people isn't the desire to contribute to their RRSP. It's the cash. It's liquidity. They don't have $20,000 sitting in a checking account.
That is the number one barrier. And that leads us to the first tool we need to talk about, which is the RRSP loan.
And this is where people get nervous, right? We're trying to get out of debt, but you're saying we should borrow money to do it.
It feels completely counterintuitive, I agree. But you have to separate the emotion from the math here. An RRSP loan is a very specific product. It's a personal loan designed exclusively for making that contribution.
So the bank knows where it's going.
Exactly. The money often goes straight from the bank into the investment account, so the rates are better. Typically, they flit right around prime. So you're borrowing at, say, 4.45% today.
Okay, so I borrow at 4.45% to put money into the stock market.
Yeah.
If the market has a bad year, I could lose money. That feels risky.
It would be if we were just betting on the market. But the double win isn't about investment returns. It's about the tax spread. We're going to use a strategy called the gross up.
Gross up. Okay, break that down for me.
The gross up is this idea where you don't just borrow a random amount. You calculate the exact amount of money that your tax refund is going to cover. You're basically getting a short-term advance on a check from the government.
Can we run the numbers? I want to see how this actually works.
Sure. Let's use the Manitoba tax rates from our source material. Let's say you're a good saver and you've got $5,100 in cash ready to go.
Okay, $5,100. That's my seed money.
And let's say your marginal tax rate is around 33.25%. If you just put in your cash, you'd get a refund of about $1,700, which is nice, but It's not going to save your mortgage.
Right. It buys a new laptop, maybe?
Exactly. But with the gross up, you use a formula. It's your cash available divided by 1 minus your marginal tax rate.
You're going to walk me through the math on that one.
So you take your $5,100 and you divide it by roughly 0.67. That tells us you should borrow an additional $2,500.
So my total contribution becomes $7,600, my $5,100 plus the bank's $2,500.
Correct. You contribute the full amount. Now, because you've made a much bigger deduction, your refund check from the CRA comes back at approximately $2,500.
Which is exactly what I borrowed.
To the penny, if you do the math right. So you take out the loan in February, you file your taxes immediately, the refund arrives in April, and you take that check and pay off the loan entirely.
So I held the debt for, what, 60, 90 days, paid maybe 30 or 40 bucks in interest, and now I have $7,600 in my retirement account instead of $5,100.
Exactly. You just created $2,500 of retirement assets out of thin air.
Okay, that's a win. I get that part. But we promised we'd help people kill their mortgage.
Yeah.
How do we get from a bigger RRSP to a smaller mortgage?
That's the pivot. And that requires a shift in mindset. We need to talk about something called wealth velocity.
Sounds like a marketing term.
It does, but the concept is solid. It's about how efficiently a dollar worked for you. I mean, usually when people get a big refund, what happens to that money?
Oh, the windfall effect. It's free money. You book a trip to Mexico, you buy a Peloton.
Right. The double win strategy requires you to treat that refund not as a reward, but as a weapon.
So walk me through the loop. Step 1 is make the RRSP contribution, using a loan if I need to.
Right. And for 2026, the max is $33,810, by the way.
Step 2, file taxes, get the refund, pay off that short-term loan.
And step 3 is the critical part. You take the entirety of that refund and you apply it as a lump sum prepayment against your mortgage principal.
Now, I can hear people listening thinking, okay, sure, putting $5,000 on a $500,000 mortgage. Does that really move the needle? It feels like a drop in the bucket.
It matters immensely. And this is where people really misunderstand how mortgages work. In Canada, they are brutally front-loaded with interest.
Explain that.
Yep.
Because I think we all know it, but we don't feel it.
Well, when you make your regular monthly payment, especially in the first, say, 10 or 15 years, you're not really paying off your house. You're mostly just paying rent to the bank.
Rent on the money.
Exactly. A huge chunk is interest. A tiny sliver is principal. But a prepayment is different. A lump sum prepayment is 100% principal.
It bypasses the interest calculation.
Completely. And here's the magic. Once you pay that principal down, it never accrues interest again. Ever. You have permanently deleted that portion of the debt.
So it's not just about the $5,000 I paid today. It's about all the interest that $5,000 would have generated for the bank over the next 20 years.
Precisely. If your mortgage rate is 5.25%, paying it down is the mathematical equivalent of getting a guaranteed risk-free after-tax return of 5.25%.
Guaranteed is a strong word. You don't hear that word in finance very often.
I know, but in this case, it's accurate. The stock market might get you 8%. It might also get you -10%. But paying off debt at 5.25% is a locked-in return. The bank cannot call that back.
So we're arbitraging the spread. We get a tax deduction at, say, 40% and use the cash to lock in a guaranteed 5% return.
That is the double win.
I want to see this in action. The research notes have a case study you call the Thompsons. Let's ground this theory.
Yeah, it's a pretty typical middle-class squeeze scenario you see in a lot of Canadian cities.
So paint the picture for us. Who are they?
Okay, meet Sarah and Mark. Sarah's the higher earner, making $135,000 a year. Mark earns $75,000. They have a mortgage balance of $525,000.
And it's 2026, so they're renewing at, let's say, 5.25% with 22 years left.
Exactly. Now, Sarah's in Ontario. Her combined marginal tax rate is 43.41%. That number is the key to this whole thing.
Right. For every dollar she deducts, she gets about 43 cents back.
So, Sarah pulls the trigger. It's February. She contributes $20,000 to her RRSP.
And what's the result?
Because she just erased $20,000 of taxable income, the CRA sends her a refund for roughly $8,682.
That's a decent chunk of change.
It is. So instead of going on vacation, in April, she takes that $8,682 and puts it directly onto the mortgage principal.
One lump sum. Boom. What does that do?
The impact is it's disproportionate. That single payment saves them about $21,500 in interest over the remaining life of the mortgage.
Well, wait, slow down. I want to make sure I heard that. She paid $8,600, but she saved $21,000.
Yes, because she stopped that money from compounding at 5.25% for the next 22 years. She also just shaved about 9 months off her amortization.
And that's from doing this just one time.
Just 1 year. Now imagine they repeat this for 5 years. The velocity loop. Contribute, get refund, kill mortgage. Over 5 years, she'll have reduced her principal by over $43,000 just using tax refunds, and she'll save nearly $100,000 in future interest.
That is staggering. $100,000 in interest she just doesn't pay.
And at the same time, she's also put $100,000 into her retirement account.
It sounds almost too good to be true. And you know me, my job is to poke holes in this. This cannot be perfect for everyone. Who gets burned here?
That's fair. There are 3 main groups who should probably sit this one out. First is lower income earners.
And what's lower here?
If you're earning, say, $45,000 or $50,000 a year, your marginal tax rate is much lower, maybe 20–25%. The tax refund just isn't big enough to make the complexity worth it.
For them, a TFSA is probably the better move.
100%. Keep your money liquid. Don't lock it in an RRSP for a tiny refund.
Okay, that brings up the second risk, liquidity.
This is the big one. Once that money is in an RRSP, it's in a vault. If you lose your job in June, you can't just pull it out to pay your bills without facing a massive tax penalty. You destroy the benefit you just created.
So if you don't have a solid emergency fund, 3 to 6 months of expenses, this is reckless.
Absolutely. Do not drain your safety net for this. This is for surplus capital only.
And there was a warning in the notes about something called the IRD trap.
The interest rate differential. We mentioned banks let you prepay, 10 or 20% a year. Those are your prepayment privileges.
Right. Most of us never even use them.
Correct. But if you get overexcited and prepay more than your limit, the banks can hit you with a massive penalty. It can be thousands of dollars.
So the rule is, read your mortgage contract.
Know your limit and stay within the lines.
I want to zoom out a bit. There's a psychological element to this too. This idea of loud budgeting is trending. How does this strategy fit into that?
It fits perfectly. Loud budgeting is just about owning your financial choices, saying, no, I can't do that expensive thing because I'm crushing my mortgage. This strategy really gamifies that. There's a dopamine hit when you see that balance drop.
And a paid-down mortgage is a form of security that a stock portfolio isn't.
I like to think of it as a reverse savings account. If we hit a recession in 2027 and you've lowered your monthly payments, you have a lower burn rate. You have options.
You have freedom.
Exactly. The bank can't foreclose on your RRSP, but they can foreclose on your house.
Okay, before we wrap, what about the listeners who are yelling right now saying, this is great, but I don't own a home yet? Is there a version of this for them?
Yes. And it's arguably even more powerful thanks to the FHSA, the First Home Savings Account.
So you can stack these strategies.
Absolutely. You do the same gross up with your RRSP, get the refund. But instead of paying down a mortgage, you put that refund check into your FHSA.
So you get a tax deduction on the RRSP contribution.
And then you get another tax deduction when you contribute the refund to the FHSA. It's a tax deduction double dip.
And the SHSA withdrawal is tax-free for the down payment.
Correct. For a young Canadian trying to save for a home, it is the single most powerful tool the government has ever created.
Okay, let's bring this home. Tactical checklist. It's February 7th. Clock is ticking. What am I doing today?
Step 1. Log into your CRA My account. Find your exact RRSP contribution room. Do not guess. The penalties for over-contributing are brutal.
Step 2.
Do the math on the loan. Talk to your bank. Confirm the rate is near prime. If they try to sell you a loan at 8%, walk away.
Step 3.
Contribute before March 2nd. And file your taxes the minute you get your T4. You want that refund money back as fast as possible to kill the loan.
And step 4, the discipline test.
When that refund lands, do not pass go. Send it directly to the mortgage principal. If you spend it on a vacation, you haven't done a strategy, you've just taken out a loan to go to the beach.
Simple, but not easy.
No, but facing that renewal cliff, avoiding that interest shock is probably the best return on investment you can get this year.
It's amazing. We spend so much time looking for the next hot stock when the biggest win is just reading the tax code and using a calculator.
It usually is, and it kind of changes how we should define wealth. We think of wealth as accumulation. How big is the pile of money? But in the Canadian tax system, Real wealth comes from velocity.
Velocity, I like that.
How efficiently can you move the same dollar from being a tax liability to being a debt-killing asset? The question isn't just how much did you save, it's how hard did that dollar work for you today?
That is the thought to leave on. Make your dollars sweat. Go check your notice of assessment, figure out your room, and see if you can pull off the double win. Thanks for listening to The Deep Dive.
We'll see you next time.